If you can master supply and demand, you can trade with the large institutions, find big risk-reward trades, and also bank consistent profits. In this video, I'm going to share vital points about institutional supply and demand that most people don't know about. And it's these critical points that have allowed over 200 of my students to get funded, become consistently profitable, and bank their first profits using supply and demand. This video explains what is supply and demand, how to mechanically draw these zones, how to find high probability institutional zones, how to avoid zones that are guaranteed to fail, and finally, how to enter and exit for maximum profit. But first, to take advantage of this market, you have to understand the true reasons as to why price moves. Does price move from here to here because there's more sellers than buyers? No, this is wrong. Keep watching to find out the truth. As history has repeatedly shown, traders are often emotionally charged groups of people. When traders get together in a highly emotional game of fear, greed, and FOMO, that together results in a lot of emotional activity. Their combined behavior takes on a herd mentality, and if spotted correctly on a chart, you can use this to your advantage. How so? Well, you've got millions of traders putting in millions of orders for millions of different reasons. All of this participation and order flow is what drives price to actually move up and down. That order flow is what puts price action on our chart. That price action is what creates patterns that happen over and over again. That allows us to make high probability predictions on where price is going to end up in the future. Because when those big institutions have a trade, they cannot hide their order flow, and you will see it on the chart, but only if you know exactly what to look for. So imagine you're an institution and you're looking to buy 20,000 ES futures contracts. Now there may only be a few hundred contracts on the ask while you're trying to do this. And so of course, if you want to be able to afford 20,000 ES contracts, you're going to have to go up in price just to get those. And as an institution, they're just as greedy as us. They don't want to be buying way above the ask just to get filled on all of their contracts. They want to get in at a good price. So they simply can't just market buy 20,000 contracts because they want to get in at a good price. So this is what causes a massive imbalance in price. Price moves really fast, taking up on those orders, and that's how you know that there's institutional activity. So now I'm going to go in the charts and show you guys exactly how to draw these zones and take advantage of trading supply and demand. Okay, so there's 4 ways that we actually go ahead and draw these zones. I'm going to explain exactly what they are and then show you guys on the chart how to actually draw them. So there's 4 of them here. 2 of them are for demand zones, which are bullish, and 2 of them are for supply zones, which are bearish. Now you can see I have these things up here, DBD, DBR, RBR. These stands for rally, base, rally. This stands for drop, base, rally. This is drop, base, drop, and rally, base, drop. Okay, it's pretty self-explanatory. A rally is when price moves up really fast. A drop is when price drops lower really fast. And then a B, which is a base, basically means when price is kind of in this consolidative state. So it's very back and forth, very choppy, no clear direction, okay? Now, all supply and demand zones will be drawn out of these 4 categories. Okay, so we have a rally, base, rally. Price will go up, have a nice consolidation, and then rally higher. Drop, base, rally. Price will drop, have a base, and then rally back higher. This is a reversal zone. Same with this one. Drop, base, drop is when price drops in a downtrend already. We have a base, and then we drop even more. And then rally, base, drop is when price rallies all the way up, has another base, and then drops. Okay. Now, all of these demand zones are drawn, and supply zones are drawn in these little areas of consolidation. Okay, wherever the base is where your supply and demand zones are going to be drawn. Because remember, supply and demand is all about fast price action. And right before there's fast price action, there's typically going to be a nice base area. And that's where all of these zones are going to be drawn. Okay, so these are where all your supply zones are going to be on here and all the way up here. And the demand zones will be here and down here. Now, let me show you exactly how to draw these zones, all right? So now you can see over here, we have, if you guys want to study this, we have a rally, base, rally, right? Price has 1 candle up, 1 candle of consolidation, and then a fast move higher. Again, whenever we see fast price action, that indicates supply and demand. So we have our rally, base, rally, and then we have a rally, base, drop, okay? This would be a RBD. This is a supply zone, okay? So now, how do we actually go ahead and draw these zones? Well, there's a simple way to go ahead and do this, and it's going to be something like this. We take our fast consolidative move, okay? So for this example, it would be right here. We have a nice fast rally higher, and for right here, it would be the really fast drop that we have. We take the candle right before it, okay? It doesn't matter what time frame it is. We take the candle right before it, because we got to understand, that's where those institutions are getting in. They're getting in right before the big move. Same thing with here. They're getting in right before the big move lower. So we take our candle right before, and we just go ahead and draw a zone. As simple as that. So we take the high of the body, okay, of the previous candle, the high of the body in the demand zone. We bring it down to the low, and then we extend it out, just like that. So basically, this entire candle would be our zone. Now, if this wick was something like all the way up here, doesn't matter. We would still use the high of the body of that candle, okay? So looking at the other way, it would be the opposite. This is our fast move lower right here, just like that. So what do? We go ahead and we take our candle right before that move, which would be here. We go from the body, which would be right there, all the way up to the high, and then we extend it out like that, just like this. And then boom, we have our supply zone drawn like that. We have our demand zone drawn like that. Let me show you some other examples on the actual chart, okay? So if we go ahead and take a look at ES, this is on an hourly chart, okay? I'm going to show you a few different examples. First one, you can see what happens right here. Price has a nice little rally. We have a one consolidation period, or one candle of consolidation, and then a really fast move lower. Okay, you can see the difference in price action between, you know, from this high down to here, like this action here, versus from this high all the way down to here. This one is simply a lot faster, right? We go straight down. We don't have many pullbacks. It's very clear that this is a supply zone. So what do? We take our candle right before that big drop lower. We take it from the body, which is a doji candle, so it'd be right there, all the way up to the high, and we extend it out just like that. And then boom, we have our supply zone. And you can see price comes all the way up to it, and we end up dumping after it. Okay, but I'm going to show you exactly how to enter and exit, how to actually use these zones later in the video. But for now, we got to focus on how to actually draw them the right way, okay? Here's another example. This is called a drop base rally zone. So what does price do, right? Price drops. We have a few candles of consolidation, and we have a massive, massive rally higher. We go all the way up to this high here, right? So where do we draw our zone? Well, if this is our massive candle of where the move actually starts, right? You want to look at where the fast move actually starts. That's going to be right here. We take the candle right before it, which is going to be right here. We take the high of the body, which would be at this 4553 level, right down to the low, and then we go ahead and extend that outward to the right. And then that is our demand zone. You can kind of guess how we trade it. You know, price comes back into it, institutions load back up, and then price ends up going back higher. Same thing with this one all the way up here, right? We take it from the high of the body. We have a nice rally, base, and then a fast drop. The price comes up to it. We actually miss it by a few ticks, but then we end up dropping and then end up going out after it. They may be saying, Jordan, well, there's another example here where, again, you know, we have a nice rally. We have a little base, just like this. And we have a nice rally after it, and the price comes down, and it goes right through that zone. You know, how would I know not to enter at this demand zone? There's a section in this video later on that I'm going to show you exactly how to avoid this type of situation so you're not buying when price comes back into it here. But stick with me for a second. I want to show you a few more examples just so you're totally clear on supply and demand. Okay, so let me show you Zoom. This is on a weekly chart, okay? So this is on a weekly chart. Now, what do we notice right here? We notice two things. We actually have two different demand zones, right? We have price come up. We have if we look at it from a larger perspective, right? We have what? We have a nice rally. We have a nice little consolidative base. We have a nice fast move higher. So this entire area is actually going to be our demand zone. When you notice that there's a big demand zone like that and it's kind of a bigger area, you can typically go up a time frame, right? So I can go up to the monthly, just like that. And now we have a much better zone. Okay, so I draw it from the body down to the lower end, right? So the body right before that big move to be right here. Price comes down. We end up getting a little bit of a reaction after it. If I zoom in on a weekly here, you can see we get a small bounce off of it, and then we end up going lower, okay? Like I said, later I'll show you guys exactly how to avoid that situation, all right? Now let me show you one more example on TTD, okay? Beautiful example right here. What happens, right? Price has a nice rotation up, nice consolidation, very, very fast move higher. This is a rally, base, rally zone. So we take our zone from the high of the body right before that massive move, right down to the lower end. Price comes down right into it. That's when we want to be buying, and then we end up coming back out. You can see we have another example here. We have a nice little rally, one candle of base, and then a nice fast drop. Again, look how fast this move is. We go all the way from 90 bucks down to 55, almost lose half of the value in, this is 2 weeks. Okay, this is such a fast drop. That's why it's so powerful. Okay, so we know institutions were selling or shorting up in this area. So when price comes back in, we draw our zone just like this. That's when we end up selling back off out of there. Okay, so I showed you a few different examples of supply and demand zones. And next, I'm going to show you guys exactly how to make high quality zones and how to trade them the right way. Okay, so you may be looking at your chart and you may be saying, Jordan, there's so many zones on here that simply don't work out. Okay, there's this one right here where, yeah, we get a little bit of a bounce, but then immediately goes right back below that zone. So how do we actually avoid taking zones that are like this and make sure that we're taking zones that we know for sure are actually going to work out? Okay, I'm going to show you an example, a really trick that actually works extremely well. All right, and everything with this has to do with trend. Okay, trend is a little bit of a different concept compared to supply and demand, but it's extremely important that you actually understand this. All right, so trend, as with downtrend, we all know is higher lows and lower lows. Okay, when we have higher lows and lower lows, that is a downtrend. Now, what you need to understand about which zones are going to work and which ones aren't going to work is all about who is stronger and who is in control. If you can identify who's in control, you can make a lot of money with supply and demand. All right. So in a downtrend, it's pretty obvious who's in control, right? Sellers are in control. Now, price cannot always go from demand to supply, okay? It cannot always go from supply to demand, right? If we have a demand zone up here and supply zone up here, price simply cannot just every single day or every time go from one to the other, simply because price would just be stuck in a range. At some point, price has to break either a demand zone or supply zone. All right. And the way that we're able to stay out of that and not get in while it's breaking is of trend. All right. So in a downtrend, okay, demand zones are simply not going to work, right? Because we're in a downtrend. And while this is going on, we may have trends like this. Sellers are stronger. Sellers are going to, take out that demand zone, which means you don't want to be buying in those demand zones, right? You simply want to be shorting in supply in a downtrend and only buying in a demand zone in a uptrend. All right. So let me show you an example here. This is Zoom on a daily chart, right? Very clear what's going on. Price is going down. We have a low, a high, a low, a high, a low, a high, and then a lower low. All right. Now, why does this demand zone not hold? Okay. You can see we got a small bounce for a little bit, and then we end up going right below it, right? And so we're trying to catch massive moves. We're trying to catch down here and have this go all the way back up, right? So how are we able to avoid the fact of trying to buy at this demand zone here? Well, it's one simple concept. All you have to do is look at the demand zone, look to the left, and ask yourself, was price able to take out supply, right? If we're in a demand zone, you look to the left and ask yourself, are we able to take out supply? Now, what does that mean? Well, you find your nearest high of that downtrend, okay, which in this case would be right here, just like this. Then you ask yourself, is there a supply zone there, or are we able to take out that high, right? And you can see, well, yeah, we had a pretty fast move lower. We had a nice little supply zone right here. So now we ask ourselves, was price able to get above that high? Was price able to take out supply? And the answer is no, right? That shows us that these buyers were not stronger than these sellers here, which means we don't want to be buying if that's the case, right? Sellers are still in control. These sellers here defended this high. They were not going to say, they were not going to let price get back above this high, because a lot of people have their stop loss above here. So it tells us that sellers are still in control. And while sellers are still in control, we don't want to be buying in demand, okay? And this is going to happen on multiple occasions on multiple different times. Let me show you another example here on Apple, okay? Now, Apple, for a while, was in an uptrend, right? Higher lows, higher lows, higher lows. And then we start to see something else form. We start to see a downtrend form. Okay, so while we're in this uptrend, it makes sense to be buying in demand. But now we see a shift in trend. We see price start to move lower and a downtrend form. Okay, so we have this high, this low, this high, and this low, which is right here. Now we have a demand zone just like this down here, right? We have a nice drop, base, rally higher, and price ends up going way below. We actually end up gapping way below it down to 150. Okay, so how do we avoid buying in this zone? Well, what do? We tell ourselves the rule. We ask ourselves, is price able to take out the most recent high/supply zone? In which case would be right above here, all right? You can see price has a nice drop. So we have rally, a base, and then a fast drop. price comes back up, are we able to take price above this high here? That's what you have to ask yourself. Are the buyers who bought down here stronger than the sellers up here? And the answer is no, right? Price was not able to get above this supply zone. So when price comes back down, what do we expect? We expect price to continue moving lower. And that's exactly what happens. Now let me show you another example and also show you when this changes, right? Same thing here. In a really micro example, price is coming down, okay? We have a high, low, high, low, high, low, okay? We're in a downtrend. Now, we take a look at this demand zone right here. Are these buyers able to take price above the sellers up here at this supply zone, okay? No, right? We reject that supply zone, we end up coming back down, and we go below that demand, which makes sense because the sellers are still in control. They are stronger than the buyers down here. Now, something changes here, right? We see that a new supply zone forms, just like this, and we see that a new demand zone forms, and this demand, the buyers here, took price above supply. Okay, that shows a shift in trend. That tells us that the buyers here are now in control and they are stronger than the sellers up here. And when we see that, now we have a shift in trend. So at this point in time, when price is all the way up here, we can now tell ourselves, okay, price has gone above this high, price has gone above the supply zone. These buyers are now in control. They control the market, right? They were able to take out supply. So when price comes back down to demand, this is a demand zone that we want to be buying. Okay, just like this. And then we ask ourselves, okay, does another supply zone form? Yes, we see another supply zone form all the way up here, right? Beautiful example of a rally, a base, and a drop. Comes right into demand, and then we end up breaking past supply. And you may be asking yourself, well, Jordan, why wouldn't you want to look to get short at this supply zone? Well, the answer for that is very simple. Were the sellers here able to take price lower than the buyers down here? No, right? Demand was stronger. The buyers down here were able to hold on and take price above the sellers here. And so because of that, we don't want to be shorting at the supply zone when price comes back into it, okay? So by being able to identify trend, by being able to understand who's in control, whether it's the buyers or the sellers, if you stand there and look left and up and see what's happening, are we able to get above supply? Are we able to get back below demand? Using that is going to make trading so much easier and make you a lot more money in your trading if you can avoid shorting zones like this or buying demand zones like this, okay? So I hope this section really helped you out. I'm going to show you another example of how to take high quality zones to make sure that you get the best opportunity for maximizing profit. Okay, so there's two concepts about supply and demand that are extremely important to know, okay? And that is going to be depth and time. And I'm going to explain exactly how you can use that in your trading to trade supply and demand the best way, all right? Now, what do I mean by depth and time? Okay, well, depth means something like this, all right? If we have a demand zone that looks like this, let's say it's a demand zone, so price is currently above it, and we're looking to buy when price comes down into it, right? Depth is how far price comes into that zone, okay? Sometimes price will come and just scrape the very top of the zone and then go higher. Other times, price will come down all the way towards the bottom of the zone and then end up going higher. Okay. Now, depth is very, very important when understanding which zones are going to work and which ones are not going to work. Okay. I'm going to show you in this video a few different examples of ones that are really good and also ones that are really bad so you can avoid them. Okay. Now, the other one is going to be time. And again, I'm going to show you some examples, but to quickly go over time, that's very simple. That's how much time is spent inside the zone, right? Sometimes price will come inside, will consolidate for a few days or a few hours, depending on the time frame you're looking at. And then we'll end up going back higher, okay? Other times, price will just immediately come, touch the zone, and then immediately go back the next way, okay? It'll spend like an ounce of time or a few minutes or a few days, depending on the time frame, again, inside the zone and ends up ripping the other way, okay? So these are very, very important topics when it comes to actually understanding supply and demand. Now, which ones do we want that are good and which ones do we want that are bad, okay? Now, remember this rule of thumb, all right? The less time it spends, the better, and the less depth there is, the better, okay? So less time and less depth is what you want. That indicates a strong zone, whether it's demand or whether it's supply, all right? And it's all time frame relative as well, and I'll get to that in a second. But take a look at Caterpillar, okay? Why is this demand zone really good? You can see that price has a nice rally, base, another rally, okay? Why is this such a good demand zone? Well, what do we see? Price comes down. we spend, let's talk about time first, okay? We spend about 2 days inside on a daily demand zone. That's pretty good, okay? 1 to 2 days is pretty good. Okay, so 1 day, 2 day, and then we immediately rip the other way. We immediately see a nice fast reaction out of it. We go right to the other side, okay? So that shows us immediately, hey, we barely spent any time in the zone. That's pretty good. The other thing is depth, okay? How much of the zone did we actually penetrate? How much of the zone did we actually go inside? Well, if we take a nice little, Fibonacci retracement, you can see price didn't even get to the middle 50% mark, okay? We probably went about 25% inside of the zone, okay? That's pretty good. I would say anywhere above the 50% of that zone means it's relatively high quality. Anything below that is relatively low quality, okay? So this was a pretty good zone, right? We had only 2 days. We came and just scraped the top of it, and then we immediately went higher. That is a really good sign. That shows you that after this happens, that this zone should hold, and you can look for more entries up here. Like I said, I'll show you guys more about how to get, how to actually enter and exit later in this video, all right? Let me show you one more good example on Caterpillar, all right? Really, really nice zone. Okay, we have a really nice rally to, consolidations of bases and then a really fast drop as well. Now, what happens when price gets into it? What happens? All right, if I draw my zone actually like this, yeah, right at the body right there. Look at that. We barely scrape it. So in terms of depth, that's perfect, right? We just scrape the top or scrape the bottom of that supply zone. That indicates a really good zone. Okay, and the other thing with time, again, we've probably spent like, I don't know where my 30-minute chart went, but we probably spent like a few minutes, maybe 30 minutes, maybe an hour, looking at the daily supply zone. We only spent 1 day in the zone, okay? That's really good as well. Then what happened? We immediately reversed, okay? And then you can go ahead and look for an entry after that. But by being able to wait for price to come into that zone and say, okay, how much time is spent in the zone and how much depth, how much did we actually go inside the zone, you can use that in your advantage and take much higher quality zones, all right? So let me show you a few other examples of ones that would be pretty bad, all right? So SPY, what do we notice here, okay? We have a really nice supply zone here. We have a nice rally, nice, few candles, almost about a week of basing, and then a nice fast drop lower. Really beautiful supply zone, okay? Now again, going back to what I said earlier in this video, price was able to get back below, this demand, or back below this low here. So this is a pretty good supply zone. Really fast drop, really nice tight consolidation. But what happens? Price actually ends up going way past it. And why is that? Well, if we look at the zone we have drawn here, what do we notice about depth and time, okay? If we look at time first, we spend 1, 2, 3, about 4 days inside of the zone, really 5, 6, 7, and then we end up going higher. Okay, so we spend a lot more time inside the zone, and we also close inside the zone. Okay, when you're looking at daily or weekly candles, or even any time frame really, if you get a close inside of the zone, it's typically not a good zone. Okay, typically something you want to stay away from, typically something that's lower quality. All right, so you can sit 1, 2, 3, 4, 5 days inside. That is not good, all right? Now, the other thing is depth. What happens? On the first touch, when price came up to the zone, we came all the way up towards the top, all right? Not quite towards the top, but way more than 50% if I go from the low to the high of that zone, all right? Probably went about 75% inside the zone. Again, that's not good, okay? The best zones and the best reactions happen the fastest with the least amount of time. Because that shows that sellers or buyers, or sellers in this case, are very quick to respond. They're very quick to sell. They're very quick to have market orders instead of, wait for price to come to them and set up passive selling limit orders. So in this case, both depth and time, you can tell that this wouldn't be a good zone. So let's say you were already in short, or maybe you're waiting to get in short. You could avoid it or get out early before having price go all the way against you. All right. Let me show you another example on NVIDIA. Now, this one is a little bit tricky, okay? But it still is really, really important, all right? So nice. Same exact thing, okay? We have a really nice, this one looks like a drop, nice little base, another drop zone. DBD zone, really beautiful move, very fast, right? Able to take out this low here, really, really strong move. And what happens? Now, when price originally comes up to this zone, we can see that we actually do get a really good reaction right off the bat. Okay, so we have, one candle, we barely go inside the zone at all, and then we end up ripping right below it. So at this point, you could tell yourself this is a high quality zone. And maybe, again, showing you entries and exits later in this video, but maybe you got in short all the way up here, okay? Or maybe you got in short on the pullback here. Whatever it is, maybe you're in short somewhere here, okay? and your stop is above this high here. Now, what you can do to your advantage is if typically your stop is above here, you would have gotten stopped out. You would have taken your normal loss. But by being able to understand depth and time, you could have said to yourself, well, price came back inside the zone for a few more days here. And then price came back inside the zone for a few more days here. And we ended up penetrating the zone even more every single time. We kept going higher and higher into the zone. And when that happens, it tells you that we're filling more orders, that supply is weakening, right? There's more orders being taken, and buyers are still stepping in. They're taking price higher. So at this point, when price is up here, you could have told yourself, hey, I'm either not going to get in the trade or I'm going to get out early. I'm going to cut my losses, take a much smaller loss than anticipated because price action is telling me that this supply zone is not going to hold, okay? And if you can understand that, you can avoid taking much bigger losses. You can avoid zones like this in general, and that is ultimately going to make you a much better supply and demand trader, okay? So next section of this chapter, we're going to go exactly into entries and exits, how to maximize profits, trading supply and demand. So let's get into it. Okay, so how do we actually maximize these gains? How do we enter and exit to make the most amount of money trading supply and demand? All right, now I'm going to show you two different examples that I trade to get in and out that work extremely well. All right, now the first way is very, very simple. Okay, it's simply getting in when price comes back to the zone, setting your stop at the lows, and then targeting the highs. Okay, so if we have looking at eBay, okay, we have a nice little demand zone here right before that fast move actually happens. We take this candle. Now what do? When price comes back in, we put our entry right at the top of the zone. Okay, so right when price touches the top of that demand zone, that's when we want to get in. We'll put our stop right down there at the lows, and then we'll put our target anywhere at the next supply zone, which should be all the way up here. Okay. Now this would have been a very, very beautiful trade. This would have been like almost a, what is this, 10R trade, okay, almost a 10R trade simply by buying right off this demand zone, okay? Now, if you want to be a little bit more conservative, if the demand zone is sitting right above kind of the low, you can put your stop right there at the low. Either way, it's very, very simple. You're just getting in when price comes back to that demand or getting short when price comes right up to that supply. Okay, you can see on eBay, this would have worked really, really well. You can see another demand zone forms right here. You have a nice rally, nice little base, nice fast move higher. Right, so we take that candle right before the fast move, which is going to be right there. Price comes back down into it. So what we can do, right when price comes in, so at this day at 65.73, we get long. We put our stop right at the lows, and we could target, anywhere up here, maybe this supply zone up here, just like that, and that's a 3R trade. Okay, so this is typically how most people trade supply and demand, and yes, it works really well. But there's another way that I like to trade it that also works extremely well, all right? And here's what that way is, okay? Now, here's an example on CAT, okay? This is Caterpillar. Now, we're going to go to a daily chart, right? The same example I showed you earlier in the video, okay? Now, you could, like I said, get in right here, stop at the lows, and you would have made good money, right? But if you want to have more confirmation, right, because supply and demand is not 100%, right? There's going to be times where price just goes right below that demand zone, and you're going to get stopped out. But there's something you can do to give you extra confirmation to make sure that you're maximizing those profits and also get an even better risk reward, right? So here's what you do. You find your demand zone on whatever time frame you're looking at. Okay, I'll have another example in a few minutes showing you on a smaller time frame, but for now, we're looking at a daily chart, okay? Now, what we can do is go in on, let's say, a 1 hour chart, all right? So we go to a 1 hour chart, and then what happens, okay? We wait for the reaction. We wait for the initial move off of that demand zone. All right, so you can see, like I said, originally, we could get in right here when price comes down at demand. But what I'm going to do is I'm going to wait. Okay, we're going to wait and see the reaction and wait for another demand zone on a smaller time frame to form after we come off of that higher time frame demand zone. All right, so price comes down. We come back up. We have another rally, base rally zone that forms right here on an hourly chart. All right. Now, a time frame, it can get a little tricky, right? I was looking at a daily. Now it's like I'm looking at a 1 hour. Why not look at a 15? Why not look at a 3 hour, right? Those are all really good questions. And the truth is you can look at any of those. It all depends on what time frame you really want to trade, right? So I just went down to a 1 hour. You can see price came back down to this 1 hour demand zone just like this, right? This nice, beautiful rally, base, rally zone. We came back inside. And now what I can do is put my my entry right at that demand zone, put my stop under the lows. And there's a big advantage to this, right? There's actually a few. Number one is that, I'm no longer risking, what is this? Like 5 points on this trade. So 5 points can be a lot depending on options or shares, whatever you're trading. Maybe you want to trade a little bit less. So on this one, you're only losing $1.65, right? Now, the other advantage is that you're still going for a higher time frame supply zone or a higher time frame target, right? So in this example, if I'm trading off the daily chart, let's say I'm targeting this supply zone all the way up here, all right? Just like that, okay? So I can get in long down here at this demand zone, put my stop at the lows, and then target this high here, and I get a nice 8R trade, okay? An 8R trade is really, really good, don't get me wrong, but the cool thing about this is if we zoom down to an hourly chart, entry is here right at that 1 hour demand, stop is still right under that low of that 1 hour demand, we can still target that same supply zone. And now we have a 19R trade, okay? Much better than the original entry we got down here, okay? So by doing this, you're not only A, going to give yourself a better risk reward, but you're going to be B, risking less money, and then C, getting a better risk, or sorry, C, you're getting a better confirmation that the trade is actually going to work out, okay? So because we already saw that, hey, buyer stepped in here, right? Price has shown us that buyer stepped in at this area here, okay? Now let me show you another example. TWLO. I'm going to show you one more example on a smaller time frame, and we'll go from there, all right? So weekly demand zone on TWLO. We see a drop, base, rally, all right? Now, what do? We go in on the weekly, and we say what? We zoom in to a daily time frame. Okay, so we zoom in, and it's like, yes, of course we could get long right here at this demand, but then that's a massive stop. We're risking 6 points. We're missing 12% on the stock. Still getting a good risk reward, right? All the way up to the supply area around here. Still getting about a 2R trade, but we can zoom in and say, let's wait for the reaction. Let's let price tell us that it wants to move higher and continue going up, okay? So what do we see? We see a nice rally, one candle of a base or consolidation, a nice rally on top of it. So now we have another demand zone that forms right here, okay? So if I take that high of the body right down to the low, that's going to be our demand zone. Price comes down, we just barely tap it, and we end up moving a lot higher, okay? Now, if we're getting in like this, or we can get in right there, our stop moves way down, okay, to 64 cents. Now, again, we can be more conservative. We can kind of play around with it and move our stop below this low here, right? Give ourselves a better chance of not getting stopped out. And then we're still targeting the high all the way up here. So now we have a 4R trade, okay? And if we go with the most aggressive, with the least risk right below that demand zone, it's a 16R trade, okay? So you can get massive risk rewards simply by trading this. Let me show you another example on an hourly chart, okay? A lot more smaller time frame. If you're a day trader, if you're a scalper, this one's for you, all right? Now, earlier in the video, I showed you this exact example of ES, okay? Now, like I said, here's where this is so important. If you remember, I showed you this demand zone right here. And if we were trading the first way, right, where we just get in long right here, put our stop at the lows, we would have gotten stopped out. But if we trade this other way, where we're waiting for confirmation, waiting for price to tell us it wants to move higher, we have the advantage of not getting stopped out, all right? So let me show you an example just like this. Okay, so we're on an hourly time frame. Now remember both these zones, right? We have this drop, base, rally. We have a rally, base, drop. Now both these zones are pretty good, okay? They're very high quality, they're very good zones, ones that we want to trade. So what I can do is zoom in on a 15-minute chart, all right? Now I zoom in on a 15-minute chart, and I find exactly where my zones are, right? So these ones are the hourly zones. We have hourly supply and hourly demand, okay? Now, what can I do in this situation here? We wait for the reaction, and then we get in at another zone. Now this, I will say, this price did go all the way up to the top, so typically I would say because of depth, it's not the best zone to trade. But what do we notice as well? We notice that we get a really nice reaction out of that zone. Price comes all the way back down. We're able to just wick, at least get below this low here. So we're able to take out some type of market structure, take out some type of low. That shows us that these sellers are in control. So now what do? I see another supply zone form right here, just like this. Look at this massive move lower, okay, right at that consolidation, right at the start, just like that. Now we can go ahead and get short when price comes up to that smaller time frame zone. We're risking 2 points. This one ends up going for a nice 3R trade. It ends up going actually a lot lower, being like a 9R trade, okay? So you can do something like that. Same thing with the other way, okay? Remember, this was an hourly zone. Now, yes, you could get in long right here, put your stop at the low, and it would have worked out. But if you want to be a little more safe, be a little more waiting, for confirmation, things like that, you simply just wait. Wait for price to tell you that it wants to move higher. How do we know if price wants to move higher? Well, price comes in, we bounce, we form a higher low, we bounce again, right? We break this high. So now we start to see an uptrend form, right? We start to see price make a higher low, higher low and a higher high, higher high, higher low, higher high, etc. We start to see an uptrend form. So what do we have? Another demand zone forms just like this on the 15-minute chart. Okay, we can get in long right here at this high at 4557, put a stop at the lows. And we can also still target that high liquidity or the highest supply zone, get a nice 3-4 hour trade. Okay, so those are two different examples of ways that you can trade supply and demand, either by getting in right when price comes to that zone, or by simply waiting for a smaller time frame confirmation and getting in on a smaller time frame supply or demand zone. Now, doing all of this, combining with supply and demand, with your knowledge of market structure, should help you make a lot more money when it comes to maximizing your entries and your stops and your targets for trading supply and demand. Now, trading supply and demand is great. However, if you want to get even a better risk reward or a better win percentage, you want to combine it with other factors, some things like volume or maybe market structure. When you add these into your trading, you can actually come up with a profitable strategy that is extremely, extremely fruitful. And if you want to learn more of a strategy that I've been using for the past 2 years to trade full time, click the link down below because I made a free training showing you guys exactly what my 3-phase system of trading is and how you can do it for yourself to become a full-time trader. So check out the link below, leave a like if you enjoyed, comment other videos you think I should make, subscribe if you haven't, and I'll see you guys in the next video.